Good morning, good afternoon, good evening, everybody. Welcome to our webinar on the coronavirus implications for the economy and for portfolios. It's a comprehensive presentation of many aspects. We beg your indulgence as we go through several things that we believe are important relative to portfolio design, reflecting on what are the tailwinds, what are the headwinds, and how's the economy likely to function given the facts. One of the things we need to know about the RVW approach to wealth management is we're very much data-driven. What you're going to hear today is not so much what we expect to happen, but looking back at what has happened in similar situations and where the economy of the United States and the world is poised right now relative to the massive mega trends in place that we believe are in place and have no indication of stopping. In fact, many of them, as you will see, are basically unstoppable. And so with that as the starting point, we wanted to, first of all, I wanted to introduce my son, Jonathan, who's a partner in the firm, senior strategist with a lot of background in tax, portfolio design, and so on. We have the rest of our team in the room sitting around. We've got Simon Liu over here. We've got Mike Chen. We've got Stefan So, who's one of our senior portfolio managers and a member of the senior wealth management team. And in our Memphis office, we have Jesse Pachenko and, of course, our administrative staff also standing by. So we're introducing all of them and are happy to have you all with us today. Having said that, let's jump in and take a look at how the slides actually lay out, and let's take a look at the information we want to present to you. This is information on our company. Those of you who are watching it probably know this, but we will come back to a little bit about ourselves, although this is not a sales pitch. Those of you who are involved probably already know what we do, and you've probably had your own great experiences, and so we're not going to get into that too much. I will tell you we're doing very well. We're growing. We've opened a significant new expansion around the country, and the most exciting office actually is our Memphis office, where we believe we have not only a back office to support our office work nationally, but also a growing group of local clients in Memphis. So thank you and greetings to our Memphis office.
And in relation to unknown events, I would say that having a redundant office in Memphis with trading, back office administration, and independent custodians with Schwab and TD at the helm means that we do have quite a bit of redundancy and can handle a closure of this office for a short period if needed.
So the headline in Fortune this week, I think, is worth really pointing out, because this is really the thrust of what we're dealing with today is, what do we do amidst a plunging market, and what kind of tools do we have, emotional tools, financial tools, to cope with what would have to be seen to be a very significant decline in market values. So let's go down, first of all, and take a look at other similar epidemics. And let's take a look and see what's happened over time. And you will see that we have survived a whole host of epidemics, which in retrospect all more or less look the same. And most of the people we've spoken to, and we've spoken to several experts in viral issues, in medical
epidemiology,
issues.
A handful of physicians and experts relative to this field. And the expertise that we're relying upon indicates that from an epidemiology perspective, this is quite similar to what we've seen in the past. And this is not the kind of event that's going to cause mass panic or closure of massive cities. This is quite similar to the SARS and MERS viruses we've seen in our lifetimes.
Although, of course, the problem is when you're in it, it always feels different this time. It's only in retrospect. And as you look back at all of those catastrophes, and even to the non-medical catastrophe of 2008. And we have many clients who've been with us through all of these. None of them, other than the current one, really makes much difference anymore. And that is always the case. It is nothing other than the current decline that seems to be the worst, that's never been before, that's never going to happen again, etc. We're not the doom and gloomers. We have great faith in the system, which has shown over 200 years remarkable resilience.
The coronavirus is actually less lethal than many of the other viruses we've seen, which is why it's actually a little scarier in one perspective, that it moves because people don't even know they're sick commonly, and they see it as a small cold. And that lack of lethality is actually good news but in the short term, a little bit scary. I want to talk a little bit about how the supply chain has been affected globally by the coronavirus. And the issue that we've had is quite unique in that Chinese New Year's, followed by the Lantern holiday, was then abutted by the coronavirus. And we as a globally integrated society of market production can easily handle a relatively, a 2 or 3 week interruption. That we've seen many, many times. We've seen that with tsunamis. We've seen that with a number of other global events around the world. But what made this a little bit different, in my view, was the fact that the coronavirus itself came on the heels of an already extended production holiday in China. And for any of you who were doing business in China in December and January, you were already dealing with a 2 to 3 week delay in production, delay on supply, and then you get hit by the coronavirus. The other thing that's interesting is that the Chinese New Year's and Lantern holidays created a opportunity for this virus to grow at a rate that was quite unique relative to the time of year, and also with the proximity of the people in the festivities. Those two issues, in my view, make this quite unique. Again, you've got this huge festivity going on, creating an already 3 week delay on production and supply, followed by this excitement. And we are now, so with those things sort of behind us, China's now getting its arms around the spread. New Year's and festive holidays are behind us. We are closer to reverting to normalcy than we are or were 2 or 3 weeks ago.
Taking a look at the plunge we've seen now relative to others, most people have forgotten that in the last quarter of 2018, we had a 20% decline in US equity values. That is about 50% more than what we're having currently. So in terms of perspective, we saw this just a short while ago and nobody went crazy. So we don't react to markets. And that's something that I wanted to just mention. Nothing that we do at RVW is ever impacted by market prices or market fantasy or frenetics. We neither participate in the ebullience and joyous bull runs. We don't do anything different than we would do in a bear market. Our job is not to predict or analyze the future. All we do is look at the present and design portfolios that are informed only and exclusively by the client's financial plan and the long-term goals for wealth optimization within their particular situation. That is what guides us. So when people say to me, what are you doing differently now? The answer is absolutely nothing. The portfolios that we manage are all designed to cope with these kind of downdrafts. Our allocations, our selection process, our design process is all informed by the perennial values, the science of capital markets, what works and what doesn't work over long periods of time, as indicated by the evidence, and then applied to the individual situation of the client.
Just to reinforce the graphic, you're looking at 6 declines in this very current bull market. And the red line, the current decline, is not that different from the other declines we've seen in this market cycle.
Taking a look at the two things that were meant to, supposed to, and expected to be the safe haven in times of market collapse, which were gold and the Bitcoin market. And we're going to see that in the next slide. Take a look at gold relative to the S&P 500, and you'll see that it really didn't do what it needed to do. And in fact, it's one of the worst performers over long periods of time. You have no audio?
Testing 1 2, testing 1 2. Testing 1 2. Hold on, give you a quick second here. Testing 1 2. Okay, sorry about that.
We've got no audio at all?
No, we've had.
Oh, we just lost the audio for a little bit. Okay, sorry about that, everybody. So just going back. So we're going to show you 2 slides. One is gold, and you see it over here. And we're going to see it also with a Bitcoin in the next one, that these two, which were supposed to be expected to be the safe havens for investors in the times of market collapse, really failed miserably at this point, have failed miserably in doing their job. Take a look at Bitcoin. Once again, and of course, we know what Warren Buffett thinks about Bitcoins. He thinks they're very little different from seashells.
And I want to just go back to the gold and just talk about our view, which corresponds with Buffett's view on gold. Because I think at times like this, people are often thinking there are alternative investment options.
Right.
And we should spend just another moment talking about why we strategically choose not to include gold in the portfolio.
Sure. As somebody who comes from South Africa and is deeply aware of the gold industry and the gold impact, I will just tell you, in my final thesis at university, the topic was the role of gold in the financial system, and the subtitle was, in the United States, they have gold buried deep underground at Fort Knox in gold bars. In South Africa, that gold is extracted from deep underground in the mines of the Witwatersrand in the Johannesburg area primarily. It is then smelted and melted into bars and sent to the United States, taking it from under the ground in South Africa to putting it deep underground in the United States in Fort Knox. What has been achieved by this exercise? So I'll give you that question to ponder, as I tell you what Warren Buffett said when we were at his Berkshire Hathaway soiree, which they call Woodstock for Capitalists in Omaha several years ago. He was asked the question, why does Berkshire not own gold? And his answer was, he said, if I owned all the gold in the world currently available and smelted it into a cube, I would have a cube of gold about 67 foot by 67 foot by 67 foot. And then he said, what would I do with it? What could I do with it? He said, I, on the other hand, as Warren Buffett, know what I would do with the same amount of money. He said, I would buy all of the arable land in North America, all of Berkshire Hathaway, all of Costco, all of ExxonMobil, and he listed about a dozen other companies that he would buy. And he said at the end of that list, he said, I would still have $1 trillion left over to go shopping for other great enterprises. And here comes his wisdom. He said, now let's fast forward 100 years. The man who has his cube of gold is standing on top of it, beating his chest and imagining himself to be wealthy, but he hasn't had a morsel of food to eat or derived a cent of income from his asset base. I, on the other hand, he said, will have received billions of dollars of gains and profits from all the produce grown in the land that I own, all that arable land, all the profits made at Berkshire, all the profits made at all the operating companies, and I would still have everything that I bought and then some, in addition to that income flow. So we don't see a role for gold. We think it's a relic of a bygone era. And we've got, tons of data. If any of you are interested, just email us and we'll send you the charts. Gold is a long-term underperformer. We don't see any role for it, and it does not.
And it didn't deliver this week.
Correct.
So it's the one time you'd expect it to have delivered, it failed you.
Perfect. Of course, Bitcoin is an entirely different story, much too early to comment, except most of us who are skeptics just ran away from it and totally avoided that manic outcry, which we believe will end eventually.
I want to talk to you about equity prices. When you buy a stock, Finance 101, you're paying for the present value of the future earnings. That is fundamentally what you are buying. And in the short term, it's Graham who says in the short term, stock markets are a weighing machine. In the short term, they're a voting machine. In the long term, they're a weighing machine. And I want to look at 3 companies to show you that fear and euphoria and greed have irrational implications on stock prices. You'll see here that the value of Domino's Pizza went up about 20% during the time when the S&P 500 dropped by about 9%. And I challenge you to ask the following question. Is Domino's Pizza truly 20% more valuable today than it was a week ago? Have they expanded their footprint by that much? Has their demand truly grown by that much? Or are we seeing a euphoric reaction to the idea that this week people are going to buy more pizzas? But when you go back to the concept of how a stock is truly priced, a perpetuity is what you're buying, the present value of all future earnings. I would argue that the number of pizzas bought this week or even this month should have no long-term bearing on the ultimate value of the price of the company. I've got 2 more examples of such. Netflix, up 14% in a world when the S&P is down 9%. Sure, people are staying home this week and watching more films and reinitiating their subscriptions. And you've seen this short-term blitz of users on Netflix. But when you look at the fundamentals, the data, the science of capital markets, you need to remind yourselves that the value of the stock is really the current value of all perpetual future earnings. And that number is going to hardly be impacted by this week's usership on Netflix. I'll give you the most ridiculous example, stamps.com, up 81% during a time when the markets, the S&P, is down almost 9%. And the reason why I find this example most fascinating is when you talk about all perpetual future earnings. Does anyone listening to this presentation now think that their grandchildren are even going to remember what a stamp looks like? And when you talk about all perpetual future earnings being valued at a rate 80.91% greater today than they were last week, you must ask yourself, is this truly empirical valuations being processed by the market, or is this truly fear and euphoria?
We had the opportunity to talk to a number of really important people about this virus. Not that we have any particular insight, none of us actually, neither John nor I nor any member of our team has any particular knowledge about this coronavirus manifestation. But we did speak to the people in Israel who have actually devised a methodology where they're expecting a vaccine to come out within the next 3 weeks. And we also spoke to some local viral disease specialists, epidemiologists at a leading hospital in the area. And from both of them, we got a very calming and very reassuring idea that this is something that will be controlled in time and will be contained, and that there will be others in the future. We all need to get used to it. Things move more quickly. The world is more global. Diseases move around more rapidly. And therefore, this is a sign of things to come. What's interesting about the Israeli situation is that they didn't set about to develop a solution to this particular virus. Several years ago, they set about developing a methodology, a system, a procedure, so that when a virus manifested itself, they would have a method to kind of plug it in and have an outcome relatively quickly, because the system, the methodology will have already been established. And luckily enough, they picked a version of the coronavirus that was not very different from this one and have already worked that one out. So they're expecting that as they have now plugged this new version in, that the system they previously developed will generate a response and a vaccine rapidly. The local medical people we spoke to have all told us that they believe this is an overreaction, and that there's nothing new about this. It's no different than any of the other major viral outbreaks, all of which, certainly the ones over the last 30 years or so, have passed relatively uneventfully over time. So we generally tend to be people who react less to panics and chaos than most others. We get less motivated by good news and less detracted by bad news. Our focus is to stay the course. And the reason that we're able to do that is because the methodology we use for portfolio design assures us that internally, in an automatic, dynamic way, our portfolios are automatically adjusting to overweight to winning companies and underweight or dropping losing companies. And so we don't have to sit here and decide which are going to be the best companies next week, next month, or next year. The system we employ automatically, by its design, because it is data-driven, rather than based on forecasts and the Wall Street shenanigans, which are basically bipolar, manic depressive manifestations of overpricing and underpricing the same asset. We stick away from that and stick with the fundamentals. After all, we're a bunch of CPAs mostly, and our focus is on the bottom line. So our investors and ourselves, because we are, after all, investors as well in the RVW portfolios, are comfortable knowing that whatever companies evolve to be the winners in the future, we will automatically be participating. Here is a slide that supports a lot of what we've said. If you take a look, the blue line talks about basically the SARS fatality rate. And you see, as Jonathan alluded to earlier, that the current coronavirus has a much lower fatality rate currently than SARS did. And so for reasons that he's explained already, we have some reason to be less concerned about this disease than we ought to have been about SARS, had everybody been thinking rationally. Now, when we talk about the tailwinds currently present, we need to look at the macro of the economy, and we see that things are very well set. Here are the elements, and we'll be dealing with them in a little more detail. Number one, low inflation. And not because we expect low inflation. The markets tell us, and I'm going to go through that in just a moment. We have low inflation, and the markets are telling us low inflation is likely to stay. Low inflation is a good thing. It also means that interest rates are likely to be low because in the long run, there's a direct correlation between interest rate levels and inflation. In fact, if you go back to Economics 101, you will learn that inflation is, in theory, the sum of two things: a reward for deferring consumption and compensation for anticipated inflation. So if we know that anticipated inflation is going to be benign, which it is, we can assume that interest rates are going to be low also. So we have low inflation, low interest rates, an accommodative Federal Reserve already indicating that they will do what they need to move things through this coronavirus issue. And by the way, the global financial markets are also being told by their equivalents of the Federal Reserve that they too will be doing the same thing. And so we have those things in place. And then we have some other mega trends, which we will be dealing with in a moment. Just to go through the specifics, by comparing two Treasury instruments. One is an interest-paying Treasury bill, which we refer to as the 10-year Treasury. Currently pays, as of this morning, 1.07% per year for the next 10 years, and then refunds your principal. 10-year TIPS, on the other hand, is basically an inflation-adjusted Treasury bill. And they pay you, at this point, minus I'm not sure what I'm supposed to use with that, Simon.
Testing 1, 2. Testing 1, 2. Testing 1, 2. Testing 1, 2. Can you call Lisa and see that?
It works perfectly when I log in. I'll check it out.
I'm going to keep talking, and if we can't, we can't. Okay, so we've got a Treasury TIPS that's coming in at minus.
Okay, testing 1, 2. Testing 1, 2. Okay, apologize for that small delay there, and we are back online.
Sorry about that. Sorry, a little technical problem because the bandwidth in the office probably just doesn't cope with this, but here we are. So we've got a 10-year Treasury and 10-year TIPS. Difference between them, 1.39%. That difference is mathematically what the market is telling us inflation will be for the next 10 years. The implication, low interest rates. Those are very powerful tools for doing the work we do because ultimately interest rates determine the values of assets. And as Jonathan told you earlier, what the value of any asset ought to be in theory is the present value of the total future income flow discounted to the present. And the lower the interest rate used, the higher the present value. That's just mathematics. And so, as the Wall Street Journal correctly said, falling bond yields, which means falling interest rate levels, make equities hard to ignore. And take a look at this one. Nearly 60% of the S&P 500 stocks now offer dividend yields of at least 1.7%, beating the 10-year treasuries. So there we go. Now, the first of the big tailwinds is the fourth industrial revolution. That means taking the first, the second, and the third industrial revolutions, which you're familiar with, steam engines, the introduction of electricity, and then the introduction of computers and internet knowledge, and now moving to the fourth level, which is artificial intelligence and all the metadata stuff that is coming out that is and will continue to change the world we live in for the better. It's radically changing manufacturing, design, medicine, information, transactions. Everything is being radically changed. And we can already see some of the benefits of those things. For example, in the last 5 years, society built the largest chain of hotels without laying a brick, called Airbnb. In the last 5 years, society built the largest chain of automobiles, limousines, and taxis in the world, called Uber. And so you see the benefits right there. Airplane seats are full because of just-in-time manufacturing and yield optimization methods that basically generate full and better utilization of our capital stock as a society. So we're seeing the first big tailwind, and all companies are profiting from this. The second one, consumers are healthy. Bear in mind, the United States economy is 70% consumer-based. If you take a look at the chart on the left, you will see the massive difference between the stack on the left and the little stack on the right. That's the difference between the assets of the consumer base of America and the liabilities. The difference between them is equity. If you look at the chart on the bottom right, you see that upward sloping curve. Notice the pimple going up in 2008, the step back after the global financial crisis, and now the steady rebuilding of consumer balance sheets up to the net worth on the right-hand side of the bottom right chart. Take a look for a moment at the top right quadrant, and you'll see household debt service as a ratio of income. The combination of rising income and lower interest rates means that the affordability of debt, the amount of servicing of debt as a percentage of income, has plunged. The consumer is healthy. And if you look at the impact of that on the society we're in and the economy, we are heavily a consumer-based economy. The consumer is healthy. Now, second big trend is some changes made in the tax rate. Until about 4 years ago, 3 years ago, the United States had the highest corporate tax rate of all of its trading partners. Take a look at that orange line on the left. After the most recent tax changes, the corporate tax rate of America went down on average to 27%. Now, we are now smack in the middle of our trading partners. What was happening? And we did this over many decades, over many successive administrations, is we encouraged all of our competitive economic partners to do better than us, because by charging lower tax rates, they were more attractive as a place to do business. Think about a company deciding whether to own an automobile manufacturing plant in Detroit or over the river, over the bridge in Canada. Many of them made that decision. That's one of the main reasons why Canada has a thriving automobile business today. And so if you take a look at all of our trading partners, you will see that by having the highest tax rate, we pushed businesses to them. We are now smack bang in the middle, and business is coming back. Here's the other side of the coin. This one stacks average tariff rates for the United States and our 10 largest trading partners. You will see that we currently have the lowest tariffs in the world for comparing with our trading partners. This is the other side of that coin. If you have the lowest tariffs, what you're really saying to countries is, when you send stuff to us, we'll charge a 3.4% tariff on average. But when we send stuff to Brazil, they'll charge a 13.4% tariff. Guess what happens? Basically, we are in a position where we're encouraging them to export to us, and we're discouraging our people to export to them because tariffs are so relatively high in those locations. Therefore, this is another way in which the United States subsidized the economies and promoted the economies of our trading partners. And the trade war going on currently is all about this chart. Now we see the unemployment, part of the health of the American consumer. You take a look at the unemployment rate, extremely low. We basically have, for all practical purposes, no current unemployment. We have the lowest black unemployment ever in American history, lowest Hispanic unemployment rate ever in history. And what's very gratifying, if you take a look at the blue line, you will see that earnings are beginning to rise significantly. And that is a reassuring aspect for us, because we don't just want low unemployment. We want to make sure that Americans are earning, particularly the lower elements of society, are earning more money. And you see from this chart that they are.
I want to jump in here and just frame the last 5 or 6 slides we've gone through. We're actually prepared to support the valuations we had in our market about 3 weeks ago when I spoke in New York City. And what we were doing at that time was illustrating to our clients who we were speaking to that the values we were looking at were sustainable and fair. And we did discuss then, and we always remind our clients, that there will be short-term, unpredictable events that will, for temporary periods, impair values. But the fundamental valuations we saw a month ago were sustainable. for the reasons my father just went through. And this here recaps it nicely. At December 31st, 2019, we had all-time highs on the markets. And people were calling it a bubble, and the pundits were calling it unsustainable. But what we're looking at here are metrics which demonstrate that the valuations we've seen recently were fair, sustainable, and based on fundamentals. And what we've seen in the last week are really a fear and euphoric reaction to news and headlines.
And here you see it again. This is basically linking the S&P 500 valuations and profits. And you can see that they are totally in lockstep with a few minor variations on the way up. There is no bubble. There was no bubble at the time, and there's no bubble currently. The valuations, as Jonathan said, were fair. Corporate profits generated higher values, and that is not going to change significantly in the long run. The other thing is people are very kind of upset about the growing national debt. Keep in mind, interest rates are now so low that the cost of servicing the debt as a percentage of the gross domestic product is extremely low, particularly looking back at the 90s and even the 80s. You see that we have much lower cost of servicing, and it's the cost of servicing debt that is a critical issue. Now, one of the points we always like to show is that dividends, which are, as you've already heard, a growing source of income and become a very attractive part of our portfolios. You can see that depending on when you got into the market, so the red line means you got in the 70s, and you can take a look at the returns you're getting annually on your investment, the top of that red one. Now take a look if you got in the 1980, and you can see over there, 1990 and 2000. So you see over here the long-term benefit of investing in quality equities, and particularly those, or including those, that pay dividends. So for someone who's been in the 70s, take a look at that extraordinary percentage they're currently earning on their original investment of 67.5%. In fact, it is rumored that the Berkshire Hathaway holding of Coca-Cola now pays basically 1/2 of the original cost every year. That means every 2 years, Berkshire Hathaway collects back its entire investment in Coca-Cola. So pay attention also to the dips in 2008. And you will see that for someone relying on dividends for income, even the 2008 dip barely made a difference, because if you smooth out the rapid growth immediately before it, that big bump up, you will see that you're virtually in a smooth line going all the way up with rapidly growing dividends consistently over time. Now, one of the things we avoid is stock picking. And you can see the problem with stock picking.
The issue with stock picking is many of the our competitors or people who are engaged in stock picking and market timing are right now figuring out what the shopping list is. What are the opportunities to buy? And what we look here, if you look at the right column, the 15-year look back, during the last 15 years, we've had every imaginable catastrophe, things that make this look mild. You had a complete collapse of the banking and financial system of the world. And yet 90+% of people who are trying to decide what to buy, what to sell, when to get in and when to get out, failed to beat simply their own index. And the takeaway here, the critical component here, is this may be a new virus, but the idea that the world is seeing a new event which is causing panic and euphoria and mania is not new. We've seen it many, many times before. And we know, based on 15 years looking back at all these different sectors, that the idea of trying to get ahead of it, get out of the way of the moving train, avoid catching a falling knife, it just doesn't work. And you're better off broadly diversifying the whole market and overweighting towards factors where we end up owning quality companies with growing dividends, with sustainable and strong balance sheets, rather than stock picking and market timing, which we know doesn't work.
Because we think of ourselves not as traders of pieces of paper called share certificates. We think of ourselves, as Buffett has taught us, to be owners of fractional interests in great businesses. And when you think of yourself that way, you're not going to be dancing around in and out of stocks, trying to pick stocks and timing. What's interesting is the rotation of winning companies, which is why stock picking really cannot work.
So we're looking at here, there was the old adage, buy the blue chips and put it in the top drawer for the grandkids. And had my grandmother done that in 1980 for me, I would have landed up with the list on the left, IBM, AT&T, Exxon. It's not a single company in the left that exists in the right column today. And one needs a dynamic Darwinian system to ensure that you continue to hold the best companies in the world, whatever they happen to be. And one thing we do know is that this year will certainly shake out the losers and bear fruit to new winners. And we have a system here at RVW to ensure that we continue to own the best companies in the world, whatever they happen to be at that time.
Now, market timing, of course, is the other thing that people are doing. They've now decided it's a time either to sell or to buy. This is an important chart because it illustrates the folly of trying to pick times to get in and times to get out.
So we're looking here is a period from 1990 to 2018, nearly a 30-year run. And if you see that if you had invested $1,000 in the S&P 500 in 1990, it would have grown to $13,137 had you done absolutely nothing at all and remained invested for the full period. Had you missed just the top 25 trading days during that 30-year period, you would have earned virtually the same results as a US T-bill. What we're saying here, one way to interpret this, is that the entire growth of this period took place in just 25 trading days. And in order to earn the results of that $13,137, one must be invested for the good days, and there's no way in advance to predict which those good days are. We're sitting here today on a day when the markets, as the time of recording, were strong. Futures leading into market hours were down. Last week's events would indicate that today should have been a bad day. We reported the first US death over the weekend as a result of this virus. Today should have been a negative day based on any objective analysis you had read up until trading hours this morning. And yet, as of recording, we're up about 1%. The idea of timing the markets is a loser's game. Don't do it. And as humans, we're programmed to attempt to control the environments around us, modify our outcomes, affect our destinies. It doesn't work when it comes to stock picking.
Human beings are meaning-making machines. We seek to see meaning and patterns when there are none. And you'll see some examples of this coming up.
2.7% up on the S&P as of today's recording right now, something that no one would have predicted 12 hours ago. Volatility is the price equity investors pay for what we expect to be extraordinary gains they'll make over time.
Now, this is a very interesting one. This is what we in the investment world call bad behavior. Bad behavior is the tendency and the trend to buy when things are up and bail out when the market is down. How ironic. Take a look at the red line, which is the S&P 500, and then take a look at the green bars, which is flows of funds into the market and out of the market. What you will see is that there are massive flows into the market as it peaks and massive flows out of the market as it declines. Of course, that's why most people have a terrible experience in investing in the market, because most people get in at the top, out at the bottom, and can't figure out why they lost money in this terrible thing called the stock market. Absolutely phenomenal chart illustrating this widespread idea that you can pick the time to get in and the time to get out. And I always chuckle when people talk about this, because when Barney's had a going out of sale event tragically in Los Angeles a few weeks ago, people were lined up around the block because things were on sale. When the stock market is on sale, people run away. Just a very extraordinary human event. People pay full price for stocks and run away when they're on sale, and in everything else in our lives, we run to the sales. So here is one of our key points, which we always explain that people need to embrace as a way to view things.
Separate the term all the time versus over time. Markets don't move up all the time, but they certainly do over time. And distinguishing them is the key to being a good equity investor.
Now, one of the things we focus on in our educational process, and you'll already get the idea that we're all about education and data, not persuasion, salesmanship, and forecasts and predictions and the Wall Street hype. So in our definition, we distinguish between risk and volatility. Our view is that risk, as commonly understood, is the possibility of permanent loss of capital. That is the RVW definition of risk. Volatility, on the other hand, is owning something through a period where the market, because of its manic approach to periodically overvaluing and undervaluing equities, will leave you in a position where what you own is valued too high and then successively too low. And Warren Buffett says this very well. He says, when you're in a group of quality equities, which RVW investors generally are, a group of select companies that meet criteria, when you're in that diversified group, you're actually in partnership with this mythical character called Mr. Market. And Mr. Market shows up at your door every day, knocks on the window, and tells you what he's willing to offer you that day for your share of the business that you own in partnership with him. And here comes the Buffett wisdom. He says, the problem with your partner, Mr. Market, is he's bound to have severe mood swings. Think of him as a kind of a bipolar fellow, not on meds, who periodically goes through periods of being up, optimistic, happy, bullish, and those times are times when he will pay you almost any outrageously high price for the share of the business you own. And then he goes through periods of being down, forlorn, and depressed. We call that a bear market. And in those times, his knocking on the window will reveal the offering price that is way below fair value. And Buffett then says something very profound. He says, in the short run, the price of what you own is determined by the mood swings of this partner of yours, this mythical fellow. But in the long run, the value of what you own is determined by the profits earned in the companies you own. That is a core tenet of RVW view.
For anyone who's sat with me during a client presentation over the last 3 or 4 years, you've seen this slide before, but today or this week is the most important time to be reviewing this slide. I want to orient you as to what you're looking at here. The blue lines are the results of the S&P 500 from 1980 to the end of last year. The average of that blue line is about 9%, but there are some wild swings. But let's stay focused on 1980, when the S&P 500 delivered 26% for the year. There was a moment during 1980 when the S&P 500 had lost 17% from its peak. 17%, and that's the orange line. And had you freaked out or reacted or sold or looked to your spouse or partner and said, I just can't handle this anymore, you would have turned that ephemeral, momentary paper loss of 17% into a real, manifest, potentially non-recoverable loss. And had you done nothing at all through our counsel and our educational process, you would have clinked your flat champagne flute as the ball dropped, celebrating 26% for the year. And in every one of these years, virtually, there's cataclysmic intra-year declines with an average intra-year decline of 14%. In other words, the average intra-year decline of 14% is worse than what we've seen so far, and it's certainly with today's recovery, than we've seen so far as a result of this virus. And we need to just remind ourselves that in order to earn the 9% average compounded growth of the blue bars, one must be willing to endure the intra-year momentary declines of 14% that we know will ultimately pass.
This is an interesting chart because it shows you how frequently markets go down. It's looking at the point that Jonathan just made in a slightly different way, going further back to 1950. And you see there's almost not a year where there wasn't some kind of a decline of less or more. And yet, if you look at the slide that I'm coming to in a few minutes, you will see remarkably over long periods of time, the equity markets have delivered greater than John said, because the period he did included 2008, which was a bad year. But when you smooth out those very bad years and you look at longer terms, the equity markets have delivered somewhere around 9 to 11%, compounding annually, and because of the way we construct portfolios, almost entirely free of current income tax. That is powerful. Take a look. Here it is, another one. Drawdowns are the norm in the stock market. People are not prepared for this and are not willing to sit through these, should not be equity investors. And Charlie Munger says that. He has an amazing comment where he basically talks about the number of drawdowns that have taken place with Berkshire Hathaway stock, which has fallen down tremendously over multiple periods from the time Berkshire Hathaway was taken over by Buffett for around $18 a share and currently worth about $320,000 a share. And his words are, if you're not able to endure the kind of volatility that Berkshire has given its shareholders, then you are not entitled to the extraordinary gains that they have made. The mental mindset he advises is something called equanimity, which means feel nothing. The problem with feeling and reacting is you're likely to act on that feeling. So when you're feeling happy, you're likely to put more money in the market. When you're feeling concerned and anxious, you're likely to pull money out. The chart that you just saw a few slides ago shows you that. And so the greatest challenge for an investor is to suppress emotion. All emotion is bad. We tell clients who are thrilled with their results with us, please don't be too thrilled. You're likely to act on it. And when they're a little disappointed because the year's not a great year, as 2018 wasn't, we say don't get despondent because you're likely to act on that as well. Great investors suppress emotions and stick to data. And that's what RVW is all about. Here is a long-term chart showing you a few things you might be interested in. First of all, what happens to $1 over very long periods of time, 1926 to 2018. And you see that a dollar grew massively over that period with lots of bumps along the way. But take a look particularly to see how small caps did compared to large caps. You'll see they way outperformed, and how both of those did compared to bonds. And so you'll see that bonds in our world have a relatively restricted view. We don't view them in the way that many other people do. Bonds in our portfolio produce two things, especially at today's low interest rates. They provide a secure fund that's available in the event that the market collapses. So when people, clients of ours, are planning withdrawals, there is a safety bucket, a silo of safety money in investment-grade bonds ready to be drawn upon if needed, so that the portfolio itself can remain intact to survive and weather the storms.
We're looking at here is a bulls versus bears cycle since 1926. And it's just so important to understand when you're looking at 100 years of history that bear markets do happen. They're part of the process. But when you contrast them in terms of width, which is the duration, and height versus peak, which is the extreme, the bears are almost irrelevant in the long run. That's the key to this slide. And you'll see in the top left, it's numerically cited. Average bulls lasts 7 years, 6.6 years, producing almost 350% growth, while bears suffer for just 1.3 years and take away just 38% of that gain. And we as humans are programmed to remember the bears and the pain and the fear, and not so much the bulls and the glory and the pleasure. And what we need to do as investors is to remind ourselves that the short spurts of pain are the price we pay for the gain. Had you come into equities at the worst moment of the worst day of the worst year during the last 100 years, you would have invested $10,000 in September of 2007. And about a year later, your $10,000 would have been worth just $5,000, half of what you started with. You would have thought to yourself, I've made the biggest mistake of my life. And had you reacted, you really would have turned your wealth into half of what you started successfully. But with our counsel and the knowledge that with time, equity markets in a well-constructed model will thrive and survive, you would have closed last year with a $28,417 portfolio plus the dividends, about $35,000 worth on your $10,000 investment just 10 years ago. And what we want to encourage you to do is to ignore the news and the noise and maintain a long-term investment horizon with your long-term assets.
If you take a look at the chart, every vertical line that you see was a catastrophe at the time. Now, we know that when you look in retrospect, nothing seems to have been as bad as it was at the time. But of course, that will apply to this catastrophe as well in the fullness of time. But take a look and see how much bad stuff, how many bad headlines and scary pieces of news you would have had to ignore in order to stay the course and end up with the terrific results that you would have in this hypothetical illustration. Now, we mentioned that we look at factors that have outperformed, and just to give you a reminder of just one of the factors, you actually a second one, you already saw the small cap factor, which over time has provided better returns. But take a look at a selection of buyback stocks, companies that buy back their own companies, and see how much better they did over this period than the broad market. The chart over here shows, and we don't have to get into it in great detail, but every one of those cubes, every one of those little squares that you see there is a different aspect of the market, a different category of investing, a different style, and you can see the index at the bottom. And the amazing thing about this is there's really no way to tell what's going to be good next year. Now, of course, the Wall Street types tend to do that all the time. They are almost always wrong, but never in doubt. They can tell you exactly what's going to happen next year. And unlike almost anything else in life, they can keep being wrong and keep forecasting forever. Just imagine if your weather forecaster here in Southern California told you that tomorrow we'd have blizzards, rain, ice, and sleet, and we had another typical, California winter's day of the 70s or so. How long do you think he would keep his job on the weather station? Seriously, maybe an hour, 2 hours, a day, he'd be gone. But you look at people who get it wrong all the time, but they got it right once, maybe 10 or 20 years ago. And now we keep paying attention. Yeah, okay. So here we go, factor diversification. Let's take a look at that. John, why don't you take us through that one?
Well, it's interesting to look at how, one might say, just put your money into the S&P 500 and let it ride. And what you end up with when you do that, when you buy the S&P 500, is you basically land up with a committee-selected group of large U.S. companies overweighted towards the largest 50 companies. And if you want to be cute about it, you land up with the S&P 50 and 450 others. And this group of 50 companies tends to be susceptible to bubbles because they're weighted based on price alone. And now we're going to see this year in particular the idea of global diversification, asset class diversification, sector size diversification will shine because the top 50 companies may be most susceptible to supply chain interruptions and impacts of this virus. And what we do as diversified global equity investors is to expose ourselves to all 5 of these categories listed here.
Take a look and see how the differences were. People say, well, the S&P 500 is really all I want to own. Take a look at how badly it did in the first decade of this millennium. The first decade, you lost about 1% every year. At the end of 10 years, you lost close to 10%. And then see, just at the bottom line over there, the total return. Take a look and see how mid-caps, small caps, emerging markets, and international did over that period. So emerging markets happen to be out of favor right now, but see how well they did over that decade. Omitting any of these risks the possibility that you could severely underperform the target that you need for your long-term financial plan. Diversification converts risk into volatility and smooths out portfolio rides along the bumpy ride upwards.
Okay, well, here at RVW, it's a good time to circle the wagons and remind you of what we do here for you, for our clients, to provide guidance and confidence during this tumultuous times. And the image of a sailboat is particularly apropos as we sail these rough seas. But our job is not to predict where the wind is coming from, how strong it'll be, but rather to build a sailboat that will go the furthest distance for every gust of wind and to survive whatever storm the markets throw at it. And so we design the boat to be diversified globally by sector, by size, by industry. We set the sails appropriately to make sure that each of our investors has the sails that are appropriately positioned for their objectives and needs, with the rudder and tiller deep enough to provide the stability that everyone needs. On their own, we minimize the headwinds of costs and fees and expenses, and then we let the wind do its job. And during this cycle, there will be winners in that, and it's not something we've discussed historically or up until now, but in this craziness of market cycles, there will be winners that emerge. And we are here to ensure that even those winners are included in the portfolio appropriately. What happened?
No, this is the story of RVW in a single image. This is the best way to view equity markets when you're an RVW client. The stock market is like a man or a person walking up the stairs with a yo-yo in his hand. The key is to watch the feet and not the yo-yo. That means tune out the noise and the news and focus on the long-term plan. That is really the way to do it. And by focusing on what you can control, which is portfolio design, asset allocation, costs, and so on, and ignoring the stuff you cannot control, which, by the way, doesn't only apply to investing, it's actually a good way to live your life. You'll optimize your possible position. Now, we're now going to talk about what we do as fiduciaries.
Well, one of the things that's unique about us, our firm, is that we're pure fiduciaries when it comes to portfolio design and construction. So when we give advice, when we build portfolios, we're doing so to the best interest of our clients, bar none. We are not influenced by commissions, kickbacks, loads, fees, or what the back office is encouraging us to pump or produce, but rather we're recommending the best portfolio and using the best, cheapest, most efficient and effective ways to achieve those goals, unlike many of our peers, whose duties are limited to what's called suitability. Many of our peers have a duty which calls for them to define the broad asset class appropriate for a client, and once that's been defined, they're entitled to, and presumably will, use products to fill those buckets that they're incentivized to use. And when the insurance company or mutual fund company pays your broker a 4 or 5% load to get in and 2 or 3% annually to stay in, where does that money come from? It comes directly from your participation. And so here at RVW, we're unconstrained. And that lack of constraint is particularly valuable today when we don't have to sell for some third-party reason or for some external reason. We have the latitude and freedom to remain invested, to weather the storm, and to come out the other side, which many of our peers and hedge funds don't have that luxury to do. So this idea of being a pure, unrestrained, unconstrained fiduciary to our clients has become particularly valuable this week.
Basically, we have a philosophy here, which is there is no compromise on integrity. We know who we work for. It's for you, our clients. So we'll end with the slide we started with. Resist the urge to panic. Don't be worried about the stock market. The economy is just fine. There will be bumps along the road upwards, as there always have been and will be. And our job is to stay buckled in as the journey continues. Thank you. Be bullish.
I just want to remind everyone there that we look forward to receiving your calls. We are here for you. Now is a time to meet and review the plan and to discuss long-term objectives. And we invite every one of you to please call us, schedule a meeting. We have the time. We want to see you. We want to meet. We want to review things with you and your family and your kids and those around you. So please take a moment, give us a call, and we'll get a calendared meeting scheduled promptly.
And if I may just add to that, we're not just stock sellers or portfolio designers. The team here includes wealth managers as well as financial planners and tax people. We're, as I said earlier, basically a bunch of CPAs who understood that in order to be a wealth manager, you need to have the tools of a CPA. Who better to trust with bottom line focus, numbers, accounting, financial statements, cash flows, balance sheets, all the stuff that you need to know to design a financial plan, rather than golfing and yachting, which basically, I must confess, none of us actually do. We're focused on your long-term financial well-being. That's all we're focused on, every aspect of it. Your estate planning, your insurance issues. Even though we don't do those things, we know enough to guide you and to oversee the process. Every single aspect tailored to your needs. And as your situations change, we will be there for you, always. Thank you.
Thank you very much.